If you clicked on this video, you want to know how Warren Buffett values a company. In many of his shareholder meetings, he's said that if you can figure out the company's intrinsic value, we can compare that value to what it's trading for, and if we find that it's undervalued, then that can help us make money. Let's watch this 20-second clip from Warren Buffett himself on how to calculate the intrinsic value of any business.
The intrinsic value of Berkshire, like any other business, is based on the future amount of cash that can be expected to be delivered by the business between now and Judgment Day, discounted back at the proper rate.
So the intrinsic value, in his words, is based on the future amount of cash flows that can be expected by the business, discounted to the present at a proper rate. That might sound a little confusing, but in today's video, let's break down exactly what Warren Buffett means by this. I'll walk you through a simplified discounted cash flow of a hypothetical business, then we'll go through a live example using Apple stock. By the end of this video, you should have a better understanding of how to value a company similar to Warren Buffett so that you can use this information to your own advantage. Before we start, it would mean a lot to me if you valued the like button and just hit it for me really quickly. And also, I have a small announcement to make, which is that my free newsletter, Hump Days, is back. So it's my free newsletter in which we discuss financial current events, and I'll also give you some nuggets of information on the investing world. You can check it out in the description below. It's completely free to sign up. So with that said, let's begin. So let's break down the whole future cash flows discounted to the present and what Warren Buffett actually means by that. So a popular method in which to value companies is called a discounted cash flow. So let's do a really simple one using a hypothetical gaming business. Let's say you want to buy this gaming business because they make a pretty awesome game. Maybe it's World of Warcraft or something like that. And you're having a chat with the owner and he tells you that his company has been growing at a small clip of 5% a year and it's been in business for about 5 years. When you ask him what his revenues are, he says that this past year they've generated $400,000 in revenue. That's pretty cool. So you expect his business to keep growing, but you're looking to buy it today. So what should you pay for it today if you wanted a return on your investment? By having the two pieces of information that he gave you, which is the 400,000 revenue figure and the 5% growth rate, you can reasonably project out his growth over the next 5 years. And if you can work backwards to figure out what you should pay for that business today, you can get a good number for that. So in our hypothetical example here, in year 0, he made $400,000. So in year 1, assuming the same 5% growth rate, his revenue would then be $420,000 in year 1. And then in year 2, it'd be $441,000 and so on until year 5. Some models out there will project out cash flows 10 to 15 years and discount them back to the present, but we're going to use 5 years for this hypothetical gaming example because I think it's a more realistic number of years. It would be unfair to expect the same amount of growth rate from an infant company over 10 years, especially if they're continuing to innovate. So a good example of this would be like Netflix. If you were trying to value their business before they started streaming, the projected growth rate of Netflix before it was streaming might have been very much lower. With more seasoned businesses, we could use 10 or 15 years of cash flows out there, but in our gaming business example, since we're only using 5 years, by year 5, it will be pulling in a projected about $510,000 per year in revenue. So we need to figure out what those cash flows are worth to us today if we're looking to buy it. So we need to apply what's called a proper rate or a proper discount rate. Now, the discount rate that investors use when it comes to a DCF, which is discounted cash flow, varies wildly. Some analysts will just pick a discount rate that fits their models, like let's say between 8 and 10%, and some will say that you actually need to use the weighted average cost of capital, or WACC. After doing research on the topic, in both situations, it is largely assumption-based. If your assumptions are wrong about the business, any DCF that you can create can be deceiving. So it's then more important to actually choose very conservative variables and apply what's called a margin of safety, which provides a cushion against errors in our calculation. That's actually how Warren Buffett and other legendary investors do it, and this margin of safety is one that we'll actually talk about at the end of this video. For simplicity's sake and our model today, we're going to set our discount rate as the required annual return on our investment because ultimately that's what we care about. How much of a return on our money are we getting? So in year 1, the business is expected to make about $420,000. So if we wanted a 10% return on our investment, we'd be willing to pay $381,818 for it today. That's because if we pay $381,818 for the expected cash flow of $420,000 in a year from now, that actually gives us exactly exactly a 10% return on our investment. And by using that discount rate, by year 5, the company will be generating about $510,000 in cash flow. And at that point, if you wanted a 10% return on your investment, you would know exactly how much to pay for that cash flow today. Now, when you're buying a business, there's typically a multiple of cash flows that people are willing to pay for it, and people are willing to pay this premium up front since the business will continue to generate cash flows into the future. In our example today, we'll use a 15x free cash flow multiple. And why 15 times? Because in general, the multiple that you can sell a business for is typically between 10 to 15 times its free cash flow. This multiple also varies by industry, but since we have a software/online gaming business, we'll assume 15 in this case because it's a high quality business. So in year 5, if we sum up all the cash flows and then add the price that we're going to pay for this business at a 15 times multiple, that's what we'd be willing to pay for the business today, or the intrinsic value of what that business is today. That number is $6.89 million. So that's what we should be willing to pay for it today based on its future cash flows. And that means on our investment, we can actually expect a 10% return every year for the time that we own it. Now, guys, this is just the tip of the iceberg when it comes to valuing companies. Many analysts and professionals will use these basic principles, but are admittedly much more advanced, and that goes beyond the scope of this video. It is my hope that this video inspires you to learn more about valuing companies. So with that being said, let's actually check out a live Apple example in the next part. So I have my computer right here, and I'm gonna just do this live for you guys. So in this scenario, let's use Apple stock. So first we need to find Apple's free cash flow, and you can do this just by Googling. Just go to google.com and type in Apple free cash flow. And honestly, the first result that pops up is this one from macrotrends.net. And if we actually just click on it right here, we can see that the free cash flow for Apple in the year 2020 was around $73.365 billion. So what happens if you actually Google Apple free cash flows and you can't find that Macro Trends article or that website? What you can do is actually go to sec.gov, and I actually have it pulled up right here, and you can go to their company filings. So if you click on company filings right here, and then you type in the ticker symbol, so Apple in this case, we're gonna look them up. And once you get here, you want to click on their 10K annual report and go to their latest annual report, which is right here. Once you get in there, you want to look for the consolidated statement of cash flows, which I already have pulled up right here. And the line that you're looking for is the cash generated by operating activities. That's their cash flow. So it's about $80.67 billion. Then you want to subtract the total capital expenditure. So that's actually payments for acquisition of property, plant, and equipment, or otherwise known as PPE. What's interesting here is that if you take their cash flow, which is $86.74 minus $73.09, which is the PPE, you actually get the same result as earlier, which is $73.365 in cash flow. So I'm going to go back to my model over here and just type in this cell $73.365, because this is going to be in millions dollars. And as you can see here, we have the free cash flows, but every single year it's the same, and the present value of it is the same as well, because we haven't entered in a growth rate or a discount rate. So to get to the growth rate, what we're going to do is, I just like to use Apple on Yahoo Finance. So I'm going to go to Yahoo Finance and go to Apple and click on Analysis. And once you're on the Analysis tab here, if you just scroll all the way down, you can actually see what their past 5 years growth rate has been, which is about 8.42%. Now, for the next 5 years, the analysts actually are projecting 17.93% of a growth rate. Now, that's a pretty large disparity from the past 5 years. So I'm going to choose a number for the growth rate that's in between that. So I'm going to choose 12%. So back in my growth rate model, or my DCF model here, I'm going to type in 12%. And as you can see, that changes the free cash flow numbers here, and also the present value of the free cash flows. But now we need to assume a discount rate, and for the discount rate, I just like to use 10% because that assumes a 10% rate of return that we want. And for the free cash flow multiple, we've chosen 15, which indicates it's a high quality business because it's Apple. Now for cash on hand, this I didn't cover in the initial example, but you want to add back any cash that's on hand to the intrinsic value figure, because that can be pretty significant, especially in the case of Apple. So to look up cash on hand, all we have to do is go back to Yahoo Finance and click on statistics. And if we scroll all the way down on statistics, we are able to find that on their balance sheet for total cash, they have $69.83 billion. So for cash on hand, I'll put 69.8, so I'll put 69,830. for the cash on hand, and hopefully that added to the intrinsic value, which I believe it did. So after plugging in all the numbers onto our spreadsheet here, you can see that the intrinsic value of Apple to us today is $2.2 trillion. But we need to add back their cash, and after adding back their cash, we actually see that their total intrinsic value with the cash on hand is 2,272,113, and these are in millions, guys. So that's $2.272 trillion. Now, if we go back to Yahoo Finance, we can actually see what Apple's market cap is. If we go all the way to the summary button, we can see that their market cap is $2.117 trillion. That means Apple is trading below the intrinsic value at the moment based on our assumptions of growth and our expectation of a 10% return. If we take it a step further, we can actually put down what Apple's outstanding shares are. So if we go to the statistics tab on Yahoo Finance and we just scroll down, we can actually see that their shares outstanding is right here. 16.69 billion shares are outstanding. So taking that number here, I can just type in 16,690 because we're operating in millions again. And what we can do is we can divide their outstanding shares by their intrinsic value. So I'm just going to go intrinsic value divided by the outstanding number of shares, and that should actually get us the intrinsic price per share of $136. Now, if we check Apple stock currently, we actually notice that they're trading below $136 per share. That means our model would indicate that Apple stock is currently a buy if we were just basing it off of intrinsic value alone. But legendary investors like Buffett and Ben Graham would prefer that there's something called the margin of safety when looking at investing in a potential stock. A margin of safety is typically 40 to 50% of a buffer between the market price and the intrinsic value price to get the most value out of investing in that stock. This way, you're also protecting any downside that actually might occur with that stock, and it's giving you enough of a buffer. In our case, a 40% buffer would actually mean that Apple has to trade at $81.6 per share for it to be trading at a margin of safety price. The point of the margin of safety is that it limits your downside risk. It's kind of a built-in cushion, and if you're able to grab a stock at its margin of safety price, in most cases, you can expect a decent return. All right, so I will leave a link to download the model used in today's video in the description bar below, and it will also be available for free on my Patreon as a public post. If you haven't already checked out my Patreon, it's a place where you're able to support the channel, see what I invest in, and also get buy and sell alerts whenever I buy a stock. Thanks to all my existing patrons. I appreciate you being here. Lastly, if you'd like some free stocks, make sure to use the links down below for that, as it also helps my channel out tremendously. And make sure to like this video and subscribe for more personal finance from me in the future. All right, guys, see you later. Peace.